How's it going today, guys? Welcome back to the channel. Hope you're having a great day so far. So in this video, we're going to be talking about a stock that I have had in my portfolio since April of 2017, and that is a company known as Alibaba. So I just recently took advantage of this sale going on in the market here with these Chinese stocks. We are officially obviously in a bear market with a lot of these Chinese stocks down 20, 30, 40% or so. And so I knew I wanted to add some stocks to my portfolio, or really at this point in time, I wanted to add just one. And looking at the different stocks out there, I was trying to decide whether I wanted to invest in JD.com, buy some more shares of JD, or Alibaba, or possibly look at General Electric. And I looked at these different stocks and I said, you know what, I think that I'm gonna add shares of Alibaba at this point in time. So I ended up buying 20 shares of Alibaba at a price of $139.97 for a cost of around $2,800. Now I did that I think a little over a week ago, so actually by the time I upload this video, probably even longer. So I apologize for not making this video sooner. I've just been doing a lot of traveling and didn't have time to throw this together, but I wanted to update you guys on my position here and really talk to you guys about 5 of the biggest reasons why I am a shareholder of Alibaba. Now before I get into the video, I just want to mention that if you guys are interested in checking out the investing platform webull, they have a promotion going on right now where if you click on that first link in the description there and you open an account, you don't even have to fund the account, you'll get a free stock worth up to $1,000. Now if you guys are not familiar with webull, it's a free investing platform very similar to Robinhood, but they have more research tools and they have a lot of other tools above and beyond what Robinhood offers. They have free short selling, free extended hours trading. So it's basically like a Robinhood platform with other bells and whistles and different features. I am affiliated with webull. You guys don't have to take me up on that offer at all, but if you guys are interested, you can get a free stock worth up to $1,000. That is the top link in the description below. Okay, but let's go ahead and start off by going over a brief history of what has been going on with Alibaba stock. So personally, like I said, I started buying this stock back in April of 2018, and I'm going to show you guys exactly what point I began buying that, and it's pretty clear why I bought at this point in time. So back in January of 2017, that is when this rally really began with Alibaba stock. They went from trading at about $90 per share to $175 in just 1 year time, that being a 95% return. So anybody who invested in Alibaba stock, if pretty much anybody who bought it in 2017, I think it was just about impossible to lose money on Alibaba stock in 2017. It went up like a rocket, as many stocks did. Now keep in mind, this is a stock that had an IPO price of $68 a share back in 2014. So early investors of Alibaba, if you held that stock from 2014 to the end of 2017, you were looking at a really nice return there. So a lot of early Alibaba investors were very happy with this investment. So then in January of 2018, towards the end of the month, the stock again went on a tear. It went from $175 to $205 a share in 1 month's time. Again, a 17% return in 1 month. A lot of people would be happy to get that return over a year. So when you see a stock shooting up close to 20% in 1 month, that is when you might start to get concerned and say, okay, you know what? Yeah, you want to see a stock going up in price, but for it to take off in such a short period of time is definitely a red flag in my book. Now after that, that is when we started to see a little bit of trouble with Alibaba stock. We saw that sell-off taking place in the end of January. And from February to April, the stock went from 205 down to 165, which was a dip of about 20%. So April of 2018 was when I began buying shares because I saw that dip taking place. I saw a 20% correction with Alibaba. I said, you know what, this seems like a good entry point for the stock. And that is when I started buying. Now, did I go out there and spend tens of thousands of dollars on Alibaba stock? I did not. What I do, my style of investing is to accumulate shares over time. That way I can, both dollar cost average and, lower my cost basis for my position. So I don't like going all in on a stock. I'll buy a little bit and I'll build into a larger position over time. Now, that wasn't the end of the trouble here for Alibaba. After that, things looked really good. After April, from April to June, this stock went from $165 a share to $210 per share, up 27%. And I can remember at that time, people who I had told that I had invested in Alibaba, I had bought two stocks, Alibaba and Facebook, around the same time. Both of those stocks went up like a rocket, and I was up like 20 to 25% in 2 to 3 months' time. So I looked like a genius, but I knew damn well I was not a genius. I knew, okay, this does not seem like any kind of appreciation that's going to, have any chance of going for the long run. I knew this was going to be short-lived, and that's exactly what happened. Then we saw a substantial correction taking place here. In June of 2018 to now, the stock has gone from $210 a share to about $148 as of the most recent figures. And like I said, I bought at $139.97, about $140, and I feel that was a very fair valuation, a reasonable valuation for these shares. But anyways, that is a price history on Alibaba. This is an update on my purchase of Alibaba as of a couple of weeks ago. Now I'm going to get into why I'm actually a shareholder of Alibaba stock. Primarily, there's a lot of reasons to like this company, but for me, I have 5 key reasons. Number one, first of all, is the fact that the two things that I'm the most bullish on right now are e-commerce and digital marketing. I'm a shareholder of Facebook because I think that's just the best stock to own, in my opinion, for digital marketing. Primarily for Instagram, not so much for Facebook. I think Facebook is kind of, it's not dying off just yet, but it's definitely plateaued in the interest level. But I think there's so much room to grow with Instagram, and I think that they're in the very early stages of monetizing that platform. So Facebook, I love Facebook because of the digital marketing. And I think that we're only going to be seeing more and more money being directed towards digital advertising, which is just going to push up the rates people are paying for digital ads. And that's just going to be more money for Facebook. So I'm very bullish on digital marketing and advertising, as well as e-commerce. I just think e-commerce is going to be huge. I was an earlier shareholder. I'm not saying I was like a day one shareholder of Amazon, but I bought Amazon stock in August of 2017. At $9.50 a share. Now, I ended up selling out at $13.50 or so. I had a really nice return there in about 6 months. But at that point in time, I said, okay, Amazon is becoming overvalued. I sold out. And obviously, Amazon hit close to $2,000 a share recently. So to sell out at $13.50, obviously I left a lot on the table. But my opinion is that the valuation of these Chinese e-commerce stocks are much more reasonable than the valuation of Amazon. I absolutely love Amazon. I think there is huge potential with that company. I just personally can't get behind the valuation of those shares at this point in time. But yeah, so that is the reasons why I'm investing in Facebook, JD, and Alibaba. So number two, like I said, that kind of ties in with number one, is the fact that I'm more comfortable with the valuation of these Chinese e-commerce stocks. And if you guys didn't see the video I did talking about JD.com, how I plan on buying about $10,000 worth of that stock in the coming months, in that video, I go over a comparison of the valuation of Amazon compared to JD.com, and I also look at the valuation of eBay compared to Alibaba. So I'm not going to go into that valuation again in this video because I just did it over there in that JD video, but I'll link that up down in the description below if you guys want to check that out. But in a nutshell, I am more comfortable with the valuation of these Chinese companies, and I always like to be investing in stocks when there's a correction taking place. Now, in the short term, I might look like an idiot. I look like an idiot right now with JD.com because I started buying shares in about the $31 to $32 range, and I am down over 20%. So yes, you may look like an idiot in the short term, but I would always rather purchase stocks that are hitting 52-week lows as opposed to 52-week highs. And I know a lot of people have been commenting on those videos saying, am I performing technical analysis? Personally, I don't rely much on technical analysis because I'm a long-term investor, and when I believe I'm getting a good price for something, I don't mind if it goes down in the short term. But you are correct in that sense that if you are looking to optimize your entry points, if you do learn the basics of technical analysis and learn about support and resistance areas and look at simple moving averages, you would most likely be able to get in at a more optimal entry point. But for me, it's just not worth it because, I'm looking at the long-term picture. I don't really care if I can, save 5 or 10% in the short term by looking at support and resistance areas. But that's just my personal preference. A lot of people would strongly disagree with me on that. Okay, so number three, my third reason for investing in Alibaba and also JD, all these are basically the reasons why I own both of these companies, is that the Chinese e-commerce market is the biggest e-commerce market in the world. A lot of people don't realize this. They think that, e-commerce is huge in the United States, but it's way, way bigger in China. So in 2017, the size of the Chinese e-commerce market was $672 billion. The second largest market is the United States at $340 billion. So if you do the math on that, that is just about 2 times the size as the US market, the Chinese e-commerce market. So the market for JD.com and Alibaba and these other e-commerce companies over in China is much larger than the size of the market in the United States. Now, you could argue the fact that Chinese is always more forward-thinking and they tend to be a little bit more innovative than the United States, and so more people are doing shopping online in China than they are in the United States. And so I do believe that obviously the market for e-commerce in the United States is going to grow at a substantial rate as well. But the actual shopping trends over in China have changed more rapidly than they have in the United States because more people are doing their purchasing online, primarily through JD.com, which is that Chinese Amazon. And then the third largest market in terms of e-commerce is the United Kingdom at $99 billion. So China is by far the largest market out there for e-commerce, and that is why, I have my dollars backing two Chinese e-commerce companies. Number four, the fourth reason for investing in Alibaba and also JD is the fact that a lot of people don't realize this, but Amazon has very little market share over in China. It's not 50%, it's not 25%, it's not 10%, it's not even 5%, it's 2%. Amazon has 2% market share of e-commerce over in China. They have crumbs of market share over there, and there's a lot of different reasons why this is the case. First of all, one of the main reasons is the fact that there is content censorship over in China. So it's not like it is here in the United States where I can, make videos like this and throw them up on YouTube and freely speak my thoughts and opinions. Over in China, you might not be able to do things like this because the government censors content. Why does this matter for Amazon? Because one of the biggest perks to their Amazon Prime service is Amazon Video. And when a lot of that content is not allowed to be shown in China, all of a sudden the value of that is substantially dropped. You also have JD over there offering a service called JD Plus, which is a really, really valuable service, and a lot of people are enjoying the offerings of JD Plus over the offerings of Amazon, which is really geared towards Americans. I'm sure they do have content that is, geared for people in China, but it's really a native platform to the United States. So I think people are more used to using JD Plus. And, the numbers speak for themselves. The fact that Amazon has 2% market share over there goes to show you that people are not jumping on board the Amazon train in China. And then the other thing we have to mention here is that if Alibaba or JD.com were ever really threatened by Amazon, China would literally squash them like a bug. They would put in place tariffs. They would essentially block them from coming into that country. China and the United States right now obviously are involved in a trade war, and they're not going to let an American company come in there and take over the e-commerce in that country. I just think that this would never happen in a million years. If all of a sudden Amazon started having 5, 10, 15% market share, they would slap tariffs on that company, and they would do whatever they could to support JD.com and Alibaba to allow these companies to flourish because they want their own companies to own the Chinese e-commerce market. So I do not see Amazon as a threat at all to JD.com or Alibaba. And then the fifth and final reason I'm going to mention in this video as to why I'm an Alibaba shareholder is the fact that Alibaba really does not compete with Amazon. And a lot of people are going to be saying, wait a second, this doesn't make sense to me. But when you really think about it, Alibaba supports Amazon. A lot of people don't even understand what Alibaba is. A lot of people, like I said in that last video, incorrectly label Alibaba as the Chinese Amazon. They are not like Amazon in the sense of the fact that they are just a marketplace where Chinese manufacturers are selling their goods typically in bulk. And this basically integrates very deeply in the supply chain network that Amazon is involved with. So there are basically 5 key components of this network. Number one, we have these Chinese manufacturers that are making goods for customers, and they're going to be selling them to somebody else who's going to resell them. Second of all, you have Alibaba. Alibaba is simply supplying the marketplace where Chinese manufacturers can be connected with people who are looking to buy the product, very similar to eBay. eBay is not making products, but they are supplying the marketplace for the seller to be connected with the buyer. Alibaba is simply connecting these Chinese manufacturers with buyers, most of them being, or a large number being, in the United States. Number 3, you have the independent Amazon seller. The independent Amazon seller is typically going on Alibaba. They're buying product in bulk. They're bringing it over to the United States. They're warehousing it over here. And then Amazon is going to handle the fulfillment of those goods. And then when you go on Amazon and you order a phone case, it's going to come from Amazon, but you don't understand all of the steps that took place before that. Now, as much as Amazon would love to remove Alibaba from this supply chain network, there's literally no feasible way that they could do this. And as much as they would also like to get rid of the independent Amazon sellers, there's again no real feasible way they could do this either. Amazon would have to, if they wanted to get rid of the Amazon sellers, they would have to hire all these sellers. They would need to hire people to take products in from overseas, do inventory control, take photos of these things, do all of the market research and bring products to Amazon's platform. So as much as they may not like these Amazon sellers or these arbitrageurs, if that's even a word, they are very, very crucial to Amazon's business, and I don't believe they're going away anytime soon because it would be very difficult for Amazon to replace them. But in order for them to get rid of Alibaba, and again, guys, I'm not an Amazon seller, I'm not an expert at this, this is just from the way that I can see it, so I'd love to hear your opinion in the comments section below. What they would essentially have to do is get rid of the Amazon sellers and then establish relationships directly with Chinese manufacturers to bypass both of them. So in order to do that, they would have to hire all of these Amazon sellers or hire people to basically serve that purpose. And in doing so, they're putting a lot of risk on themselves. One of the main reasons why Amazon loves these private Amazon sellers is that the risk is on the seller, not on Amazon. If you go out there and you decide to buy products and bring them to market here on Amazon, you're the one who has done that research on the product. You're the one who has put that money up front for inventory. You're paying Amazon to warehouse those goods. They're not losing any money. You're paying them to hold on to those goods, and you're paying them for the order fulfillment as well in some way. So there's absolutely no risk on Amazon's part. All the risk is on you. If all of a sudden you bring a product to market and then there's a patent on it and you can't sell it, you know what? That's your bad. You're going to have to deal with that, and you're going to have to figure out what to do with those products. If Amazon had purchased those products, now they're going to have to deal with that problem themselves. And also, if a product is not selling, again, that is on you. That's not on Amazon. So if Amazon wanted to disrupt the supply chain, get rid of Alibaba, they would have to hire all these Amazon sellers to work for them, and they would be taking on a massive amount of risk by owning the inventory. They do own some of the inventory. Amazon does sell some products directly owned by Amazon, but a lot of the stuff being sold is just stuff from Alibaba being sold by private Amazon sellers. So I know that was a very long explanation there, but that is in a nutshell one of the main reasons why I like Alibaba as an investment. And I also see Amazon as, a business model that's probably going to work for a good while until Amazon can figure out a good way to, change up the supply chain. And I just don't see it here on paper. But anyways, guys, that's going to wrap up this video. I hope you enjoyed it. If you are an Alibaba shareholder, drop me a comment down below and let me know, why do you own Alibaba? If you're a bear and you hate Alibaba stock and you don't like Chinese e-commerce companies, I'd love to hear your feedback as well. Again, like I said, if you guys are looking to grab a free stock, webull has that promotion where you can get a free stock worth up to $1,000. The link is the top link in the video description. You don't even have to fund the account. You just have to open the account, and they will give you a free stock worth up to $1,000. So it's a pretty cool offer they have going on. But that's going to wrap up this video. Thank you guys so much for watching. I hope you enjoyed it, and I will see you in the next one.